The past 1 year has been extremely volatile for the equity markets. As a result, mutual fund returns have also seen a significant hit. Multi-cap funds, for example, have seen returns contract anywhere between 2% to as much as 20%. However, the Motilal Oswal multi-cap fund has managed to keep its head above water and remain in the green. Joining me now is fund manager Gautam Sinha Roy. Hi Gautam, thanks very much for joining me on the show.
Hi, thanks for inviting me.
So my first question to you, of course, is, this fund has sort of managed to keep its head above water really in the last 1 year. What has really worked and what's been the investment strategy?
I think our focus has always been to find those 15-20 stocks where earnings growth, ROE is all superior to sector levels and index levels, which is what really has worked because, growth has been very challenging. Very few companies have grown well. Thankfully, we have stuck to a philosophy of identifying high-quality growth companies, and most of these companies have delivered on that growth that we're expecting. So that, more than anything else, has worked. Also, we didn't succumb to many of the hope trades that were popular in the market in the course of the year. So that has really helped us avoid some of the mistakes which could have been there. So we haven't bought growth which is conditional on macro or certain recoveries happening in certain sectors. In fact, if you look back in hindsight, most of the recoveries which were thought about that it will happen, be it in the global macro side or domestic capex recovery, all of them have disappointed. So I think both sides, avoiding the ones which disappointed, as well as sticking to the ones where predictable growth, visible growth was there, even in cases where valuations were a little bit stretched, that has really helped.
Right.
The other thing which has worked is that, we have seen hyper valuations in certain stocks that we owned during the course of the year emerging, right? So we have been able to identify the valuation bubbles and get out of them in a timely fashion.
So you've also used this opportunity to increase allocation to some of your holdings. Without getting into the specific stocks, can you take us through the rationale for that?
So, through the course of the year, we have seen, because of certain sectoral related issues, some specific stocks which do not have those problems that the broader sector might have, seeing valuation compressions or valuations not going up in line with earnings growth or the kind of profitability they were delivering. Classic example would be the retail banks, retail-oriented banks where NPA problems are not there. Earnings growth is superlative, but just because the sector is in the doldrums, we have seen some valuation opportunities emerging. The other sector which I would like to highlight would be the IT pack, where valuations are at probably a very long-term low, especially for the large cap IT pack, not really for the mid caps, for the large caps, leading IT stocks. But there you are seeing also growth compression happening. So you have to be slightly more careful. So you cannot go full gusto on them. You have to be really careful about choosing the right stocks at the right valuation. So that's what we have been attempting to do. Also, that would hold for many other stocks like autos, for example, where price volatility has been pretty high during the course of the year. So whenever we have found that the buying opportunity has emerged or valuations are in our comfortable range, we have bought them.
Right.
On the other side, again, we have also tried to book profits or exit in some cases stocks where valuations were either out of the completely out of sync with the growth expectations that are there, or the growth itself we thought was moderating or coming down.
Right.
So it has to do with having a good buying discipline as well as a good selling discipline and executing it seamlessly day after day. So that has been a very important.
Right. So the other sector I also wanted to ask you about is, of course, the aviation space, because that's been very much in the news over the past few weeks at least. What is your sense of that space? And without getting to the stocks again, what is the road forward that you see for that?
Yeah, so that space is, for good or bad, being associated with our funds because we have holdings there.
Yes.
So, when we are looking for growth, right, bottom line growth, one of the key ingredients is, of course, demand growth. And as I was trying to tell you, that demand growth has become rare and rare. It's a very rarefied commodity today in India to find demand growth which is very strong and which is also sustainable. Now, aviation is one such sector.
Yes.
Largely, probably because of the, tailwinds in terms of crude prices coming down. Also because, there are very healthy and strong operators, at least two of them now, who are driving down prices and hence increasing passenger volumes. So that's a space where earnings growth will be very good. And we're finding that space to continue to be very interesting going forward too. And it's just not only to do with lower crude prices, that definitely adds up to a lot, but it also has to do with finding the correct management, the correct business model, which is what we stick to traditionally.
Right. So in the past few months, really, we've seen, when we've seen this entire volatility really deepen further, where are you seeing value now? Because the valuations have corrected, of course, more from the large cap space than the mid caps. So A, how are you making the difference between large caps and mid caps at this point? And B, where are you seeing value across the board right now?
Yeah, so to answer that first part, large caps definitely looking interesting because mid cap valuations, are at a 15-20% premium to large caps, which is a long-term high.
Right.
So I'm not saying that mid caps don't have value in general, but you'll have to be very, very specific in terms of which mid caps you're choosing. So we have been very careful. In fact, through the course of the fund over the 1.5 years or more that the Focus 35 fund has been in existence, our mid cap allocation has come down from 50% roughly to start with to something like 20% today, and that's only to do with the fact that opportunities in mid caps in terms of great value versus growth has been lowered as mid cap valuations have risen. So obviously the answer is that we are seeing more, generically speaking, more value in large caps. But mid caps also significant value is there in a few counters, and that value is emerging more so with the current fall, where corrections have been severe. One has to remember that mid caps typically do very well in earnings growth in times of very superb growth in the economy, as well as when the interest rates are coming down.
Right.
We don't necessarily see both these factors occurring this year.
Exactly.
That's not definitely the outlook. So that's another reason why you have to be more careful with the mid-cap selections.
Would you have any sectoral bets, or do you think it's more of a stock pickers market across sectors?
It is more of a stock pickers market, definitely, because as I was mentioning, if you look at banks, for example, within banks too, it's just not private banks versus PSU banks. It's also particular banks within the private bank space which are doing well. So, you have to be very bottom up. And I think one of the approaches that we have taken throughout has been to be very bottom up, in our stock picking, and that has helped definitely. We'll continue to do so. But sectorally, yes, if I look at my portfolio, the sectors which are most overweight and hence I'm most positive on are autos, then select private banks, IT, pharma, oil marketing companies, and select bottom-up picks in the consumer space. So it's a very specific more consumer-oriented portfolio in that sense. Within that, I think the common underlying theme is a very robust demand growth in most of these companies, with a tailwind of raw material prices or operating leverage coming in, which is resulting in healthy profit growth.
So mutual fund flows, if you look at the flows in the past few months also, they haven't really been affected all that much. Investors have continued to put money in despite of the volatility in the market. But what are you seeing from the investors' perspective in terms of what are they worried about? Are you seeing any slowdown in the equity funds at all?
Well, we are seeing a bit of slowdown in vis-a-vis on a month-on-month basis from the highs that were hit towards the third quarter or early fourth quarter of last calendar year. We are definitely seeing slower inflows, but from a historical standards, last 10 years standards, flows are still extremely positive and good. I think a lot of it is driven from the basic premise of sectoral or asset allocation shift happening on the investors' part from more of inflation hedge kind of asset classes like gold and real estate to equities. And that is also driven by the fact that after a long time India is seeing positive real interest rates. So to that extent these factors remain in place. So those factors are not going to change in a while. So that should continue to help provide good inflows into mutual funds. But another thing that will play out is returns, right? So that has started becoming a bit of an issue on a one-year basis, as you were mentioning, that we are not seeing positive performance across the board from most mutual funds. So definitely would approach flows with a cautious optimism kind of a outlook, because there are a bit of concerns, but the overall macro tailwinds are very positive.
Right. And finally, as far as your fund is concerned, how do you see the returns trajectory? I mean, I know it's very difficult to predict, but do you think that there would be the positive returns will continue going forward?
Well, the aim is always to generate that, and we have a method in that madness to the entire madness of markets. We think we have identified a method how to generate returns. Essentially, we break down very simply the return CAGR into P change, delta in P, and CAGR of earnings, let's say over a 5-year period.
Right.
So we cannot do anything about the P. We cannot do much about it. We can, of course, make sure that our buying valuations are correct, and that's how we handle the PE part. The second part, earnings growth part, is definitely something that we try and focus a lot on.
Right.
Because as I was mentioning, our idea is to make sure that we have those select stocks which together give you superior earnings growth within the entire set of stocks that exist in the country. So that approach helps us. So we keep on targeting superior to index kind of earnings growth, and I think over the long term, a portfolio of stocks or an index for that matter should broadly track the earnings growth that they deliver.
Right. All right, Gautam, we'll leave it there. Thanks very much for joining in. Time for a quick break. We'll come back and shift focus to the alternative investment space. Stay tuned.